What if I told you that the biggest technological gold rush of our lifetime, the AI boom that's reshaping entire industries, may be hiding a silent countdown? And when it hits zero, as much as $10 trillion could simply vanish. Not stolen, not redistributed, just gone. You might think that's impossible, but history says otherwise, because every bubble starts the same way, with a powerful story. A story so convincing it makes us forget to ask the hard questions. Today's story is artificial intelligence, the idea that smarter machines guarantee a richer future. Investors believe it, politicians believe it. Entire companies are reorganizing their identities around it. But here's the truth. Markets don't run on certainty. They run on expectations. And when expectations outrun reality, money evaporates like mist. To understand how we reach this breaking point, imagine walking into a crowded room where everyone is whispering the same thing. This time, it's different. You've heard this line before, in 1999, in 2007, and now in 2025, it's back, wearing the sleek, futuristic mask of AI. Let's rewind. The seeds of today's AI bubble were planted in the early 2010s, when neural networks suddenly started outperforming humans in narrow tasks: image recognition, language translation, pattern spotting. It felt like the future had arrived. Companies that had never spent a dollar on machine learning suddenly built AI teams. Startups rebranded overnight. Venture capital poured in as if intelligence itself had become a commodity. But wait, that's not the whole story. Because while the breakthroughs were real, the expectations exploded far faster. Think of it like laying bricks faster than you can pour concrete. At first, the wall stands, then it leans, then it cracks. And by the time people realize what's happening, the entire structure is unstable. By 2023, AI spending reached levels no other technology had achieved so quickly. Training clusters costing hundreds of millions. Data center expansions priced like small nations. Supply chains warped around GPUs in the same way gold rush towns once formed around the promise of buried treasure. And for a while, it worked. Stock prices soared. Productivity forecasts skyrocketed. Everyone wanted a piece. But behind the scenes, a quieter question hung in the air. What if the economics don't add up? Because AI isn't magic, it's infrastructure. And infrastructure has costs, massive costs, that don't disappear just because the hype is loud. Take electricity. A single large training run can consume more power than some towns. Now multiply that by thousands of companies, all racing to build their own models. The result: energy demand curves bending so sharply that regulators began sounding alarms. But investors didn't care. They were too focused on projections showing AI boosting global GDP by double digits. Sound familiar? It should. In the 1840s railway mania in Britain, investors poured money into routes that weren't needed, lines that led to empty fields or duplicated existing tracks. The logic was simple. Railways will transform everything. And they did, just not fast enough to justify the speculative frenzy. When reality caught up, roughly half of the money invested vaporized. Today, AI is our new railway mania. You may think, but AI is everywhere. Surely that means the investment is justified. Not necessarily, because presence isn't profit, and growth isn't sustainability. Let's talk about the biggest illusion in this bubble: the assumption that more compute automatically translates into more intelligence, and thus more value. But intelligence has diminishing returns. Each new generation of models costs exponentially more to train, yet delivers smaller leaps in capability. And at some point, the math stops working. Meanwhile, companies are treating AI as a checkbox. Retailers that don't need custom language models are building them anyway. Banks are launching AI labs that resemble movie set control rooms. Lots of blinking lights, not much substance. Hospitals are adopting expensive diagnostic tools that require more staff training than they save in efficiency. These aren't isolated cases. These are symptoms. And here's the twist. The institutions funding the boom aren't actually evaluating long-term return. They're playing a psychological game called fear of missing out. If one competitor invests, everyone else must follow, or risk appearing outdated. This chain reaction inflates valuations far beyond intrinsic worth. Now take that herd mentality and apply it at a national scale. Governments are pouring billions into AI for strategic dominance. It's the new arms race, except instead of missiles, it's models. Instead of silos, data centers. And like every arms race, the costs are justified by fear, not economics. We're now facing an inflection point. The numbers no longer align. The costs are rising faster than the gains. The talent shortage is slowing deployment. Energy grids are straining. And companies are quietly discovering that integrating AI is far harder and far less profitable than the sales pitch promised. So the question becomes, when does the adjustment happen? Because every bubble ends with a trigger. One spark, one revelation, one earnings report that shatters the illusion. And that spark is closer than we think. Leave a comment. What lesson from past bubbles do you think we're ignoring today? But hold on, because we haven't even reached the most dangerous part of this story yet. The part where AI's financial ecosystem, its loans, leases, supply contracts, and speculative derivatives, creates a domino effect no one is prepared for. And when those dominoes fall, trillions don't just disappear from balance sheets, they rewrite the global economy. Picture this: a single data center packed with cutting-edge AI hardware, humming away like a metallic beehive. On paper, it's worth billions. But the moment the growth narrative cracks, even slightly, that value becomes fragile. Why? Because the financing behind these facilities isn't built on present profits. It's built on future expectations. If those expectations collapse, the valuation collapses with them. This is where the real danger lies. Not in the tech, but in the financial architecture wrapped around the tech. Think about how we got here. As AI demand exploded, companies signed long-term supply contracts for chips they assumed would remain scarce and essential. Banks offered loans using projected AI revenue streams, not actual performance, as collateral. Hedge funds bundled AI-related assets into products they could resell, just like mortgage-backed securities in the mid-2000s. On top of that, major firms prepaid billions for compute capacity they might never use, simply to avoid falling behind rivals. It's a stack of promises built on top of assumptions, built on top of hopes. And you know what happens to structures built this way. When one layer weakens, the entire tower shakes. But wait, it gets even more precarious. There's another piece of the puzzle most people overlook: the operational drag. AI systems require continuous retraining, constant monitoring, and teams of engineers tweaking models just to keep output stable. That means cost, and more cost. Many companies believed AI would function like software: buy it once, use it indefinitely. But modern AI behaves more like a high-performance race car, powerful, but demanding non-stop maintenance. Now scale that across global corporations, governments, and startups. The result? A recurring bill so large that many organizations quietly realize they can't sustain it. So they cut corners, they shrink teams, they delay retraining. Quality drops, models drift, and suddenly the AI advantage that justified massive investment doesn't look so impressive. This is where the bubble starts to show its cracks. Remember the dot-com crash? It wasn't caused by a lack of internet users. It was caused by unrealistic projections about how fast companies could monetize those users. The same dynamic is unfolding today. AI may transform the world, but not fast enough to justify $10 trillion in aggressive investments crammed into a short time frame. And right now, we're sitting on a powder keg. The expectations reset. Let's zoom in on one key pressure point: AI chips. These chips became the gold of the AI frontier. Demand surged so fast that supply chains bent under the strain. Prices skyrocketed. Companies hoarded inventory. But here's the twist no one wants to talk about. Many firms purchased more chips than they could possibly deploy. Some data centers operate at less than half capacity today. That's dead capital, hardware sitting idle, depreciating every single day. If major buyers start canceling orders or unloading surplus inventory, the downstream impact on suppliers, manufacturers, and their financiers could trigger a cascade. Stock prices would tumble, debt covenants would break, and the perception of infinite AI demand would be shattered. Ask yourself, what happens when the market realizes the demand curve was exaggerated? Another weak link is the massive spending by companies that never had a competitive reason to chase AI. Insurance firms that built giant machine learning models to revolutionize underwriting, only to discover regulators wouldn't approve the changes. Logistics companies that spent millions on predictive systems that offered only single-digit efficiency improvements cheaper tools could have delivered. Advertising agencies deploying AI-driven creative tools that produce generic outputs clients didn't want. These aren't outliers, they're warnings. But here's the truly unsettling part. Even the winners of the AI race are vulnerable. Big tech companies scaled aggressively, betting that the cost of compute would drop as fast as demand grew. But energy prices didn't cooperate. Grid expansion lagged. Materials for advanced semiconductors became bottlenecked, and cooling requirements ballooned far beyond early estimates. This is how runaway optimism turns into structural fragility. You may think, okay, but what triggers the actual collapse? Let's connect the dots. Imagine a major corporation announces that its AI investments failed to deliver promised returns. Their earnings fall short. Their stock plunges. Suddenly, analysts question not just one company, but the entire sector's projections. Investors rush for the exits. Asset managers reprice risk. Venture capital dries up. And AI infrastructure operators, who built capacity assuming a decade of unbroken growth, face a brutal reckoning. It doesn't take a catastrophic event, just a shift in sentiment. And when sentiment shifts, capital evaporates. That evaporation is where the $10 trillion figure becomes real, because so much of the AI economy is based not on tangible results, but on valuation multiples, projected market share, and speculative enthusiasm. If the correction is sharp, and history suggests it usually is, entire segments of the AI value chain could lose half their market cap overnight. And yet, the most unexpected consequence is still ahead. Because what happens after the bubble pops isn't just financial, it's geopolitical. Governments that tied national strategy to AI supremacy will be forced to rethink budgets. Countries that overinvested will face fiscal strain. And global competition for technological dominance, already tense, could turn chaotic. But before we get there, there's a deeper question we need to confront. What happens to the workforce built around AI when the promises collapse? The answer leads us into the human cost of the bubble, one that rarely shows up in financial reports, but will reshape the next decade. And that's where the story turns next. Behind every AI project is a team. Engineers, data labelers, researchers, product managers, people who believed they were building the future. During the boom, companies hired aggressively. Salaries soared. Entire departments ballooned on the assumption that revenue would eventually catch up. But when a bubble unwinds, payroll becomes the first place companies look to cut. We've seen this before. In the early 2000s, thousands of skilled workers were laid off, not because they lacked talent, but because the bets their companies made didn't pan out. And just like then, many of today's AI hires are tied not to profitable operations, but to speculative projects meant to position companies for the future. The day the AI narrative loses its shine, those positions become vulnerable. And here's the twist. The workforce isn't just domestic. A significant portion of today's AI ecosystem relies on a global layer of data annotation labor. Much of the magic you see in AI models comes from millions of human judgments, classifying images, reviewing texts, correcting predictions. These workers are often contracted through complex outsourcing networks. When investment tightens, this invisible backbone is one of the first places companies slash spending. What happens when that labor disappears? Models degrade, quality slips, AI tools become less reliable. Businesses begin questioning whether the technology can sustain itself without massive ongoing investment. The feedback loop that once drove the boom now accelerates the bust. But the human cost doesn't stop there. Let's talk about the ripple effect across industries that thought AI would transform their bottom lines. Retail chains expected automated logistics. Law firms anticipated faster document review. Manufacturers pictured fully autonomous factories. But many discovered the same reality. Integration was harder, slower, and more expensive than they predicted. When AI investments underdeliver, companies face tough decisions. Scale back spending or double down. Lay off staff or reassign them. Replace systems or patch them. In each scenario, the workforce ends up paying the price of unrealistic expectations. And while all this unfolds inside companies, something larger is happening across the economy. Remember how low interest rates fueled the early stages of the AI surge? Cheap capital encouraged risky bets. But in a high-rate environment, those same bets become liabilities. Debt-heavy firms suddenly face rising servicing costs. Cash flow tightens. Investors want returns now, not 10 years from now. And AI, an inherently long-term play, becomes a target for cuts. This tension leads to the moment every bubble fears, the mass write-down, when companies admit that assets on their books aren't worth what they claimed. Equipment gets revalued, software gets abandoned, projects get canceled. Tens of billions vanish with the stroke of an accountant's pen. If enough companies make these adjustments at once, the shockwaves hit banks, pensions, and institutional investors. That's when 10 trillion starts to disappear, not bit by bit, but in chunks. Yet even as the financial world braces for impact, there's one more layer that makes this bubble uniquely dangerous. Public trust. AI didn't grow solely because investors backed it. It grew because millions of people believed in its potential. It became the central narrative of innovation, the promise that machines would make life easier, safer, more efficient. So what happens when that promise stalls? People lose faith. Fast. Consumers who expected AI to revolutionize healthcare wonder why costs haven't fallen. Workers promised AI productivity tools realize the benefits are far smaller than advertised. Businesses that adopted AI to streamline operations find themselves tangled in new complexities. Confidence shifts from optimism to skepticism. And once the public narrative shifts, political pressure follows. Governments that spent billions on AI infrastructure face tough questions. Voters want to know why the benefits didn't materialize. Regulators begin probing claims from the boom years. Subsidies shrink. Scrutiny rises. National strategies get rewritten. This is how technological bubbles reshape policy for years. But here's the surprising twist. The fallout doesn't kill innovation, it refines it. When the dot-com bubble burst, most internet companies vanished, but the internet itself didn't. Instead, it matured. The businesses that survived learned to focus on fundamentals, sustainable revenue, real demand, practical applications, and that's exactly what will happen with AI. But before that reset arrives, the economic damage will be profound. Entire markets, chips, data centers, cloud compute, AI software will need to reprice. Some companies will disappear, others will consolidate, and the ones that remain will build on more solid foundations. Still, there's one question hanging over all of this, the question no one wants to ask out loud. Where exactly does the disappearing money go? If investors lose trillions, who gains? If valuations collapse, where does the economic mass shift? If the AI bubble bursts, what industries rise to fill the void? The answer reveals the unexpected winners of the collapse. And if you look closely at historical patterns, you'll see the outlines of that future already forming. But we're not done yet. Because the most critical shift, the one that determines who comes out stronger, happens after the panic when the dust begins to settle. And that's where this story heads next, as we uncover the aftermath of the AI bubble and the long-term transformation it triggers. Leave a comment. What's the biggest risk you think companies are ignoring right now? When a bubble bursts, the money doesn't vanish into some black hole. It shifts. It redistributes. It flows toward whatever the market decides has real, durable value. And that's the final piece of the AI puzzle, identifying where the capital goes after $10 trillion in expectations unravel. To see the pattern, look back at past collapses. After the dot-com crash, money fled from flashy internet startups and poured into infrastructure. The fiber networks, server farms, and broadband providers that actually made the digital world work. After the 2008 financial crisis, investment rotated away from exotic derivatives and into regulated banking, fintech compliance, and housing reform. In each case, the crash didn't destroy innovation. It accelerated discipline. The same thing will happen with AI. Once inflated valuations reset, the capital that remains, leaner, more cautious, but still hungry for returns, will seek out the parts of the AI ecosystem that generate real productivity. Not theoretical gains, not hype-driven horizons, actual measurable improvements. These winners fall into three major categories. First, applied AI, simple, resource-efficient models, tuned for specific tasks with clear ROI. These don't need billion-dollar training runs. They don't require entire power grids. They quietly solve real problems in logistics, medicine, or finance without grand promises. These are the picks and shovels of the post-bubble era. Second, energy and infrastructure. AI's appetite for power, cooling, and specialized chips exposed a massive fragility in global systems. When the bubble deflates, investors will shift capital into the bottlenecks that slowed AI in the first place. Grid modernization, semiconductor supply diversification, long-duration energy storage, and cooling innovations. Ironically, these sectors may become far bigger winners than many AI companies themselves. Third, human-centric technologies, tools that don't replace workers, but augment them. As the workforce digests the lessons of AI's overreach, demand will surge for systems that enhance human decision-making, not automate entire roles. Tools that are transparent, reliable, and efficient, not mysterious black boxes that require armies of engineers to maintain. But here's the most surprising winner: trust. Every bubble is a psychological event as much as an economic one. When expectations collapse, people seek stability, products that work, companies that communicate honestly, technologies that solve problems without overpromising. After the AI bubble deflates, organizations that focus on trust building will rise faster than those still chasing moonshot claims. And that brings us to the final pivot point in this story. Because the AI bubble doesn't end with a bang. It ends with a question. What do we actually want AI to do? Not what it might do, not what hype cycles tell us it should do, but what purpose it truly serves in a productive, balanced economy. Maybe it's assisting doctors, not replacing them. Maybe it's optimizing supply chains, not predicting every human behavior. Maybe it's creating better tools, not artificial superintelligences. When the dust settles, the companies that survive will be those that solve problems grounded in reality rather than fantasy. They'll be the ones that use AI as one tool among many, not as a silver bullet for everything. They'll also be the ones that rethink scale. The age of bigger models mean better results will give way to smarter models mean better results. Efficiency will replace excess. Craft will replace brute force. And in that shift, we'll see something rare: a technological field becoming more responsible, more sustainable, and more human centered precisely because the easy money is gone. But make no mistake, the transition will be painful. Markets will convulse. Entire sectors will downsize. The headlines will be dramatic. And for a while, it will seem like AI's promise was overblown or even fraudulent. Yet the truth is far more balanced. The AI bubble will pop not because the technology failed, but because our expectations soared farther than the technology could carry them. The correction simply pulls the narrative back down to earth. And that's not a tragedy, it's clarity. Because once the bubble's noise disappears, the signal underneath becomes easier to hear. The real innovations emerge, the durable businesses survive, and the focus shifts from speculation to substance. In the long run, the collapse isn't the end of AI. It's the end of the illusion that AI alone can outrun economic gravity. So as we watch a historic $10 trillion evaporate, remember, this isn't destruction, it's redistribution. Not the death of an era, but the start of a wiser one. And if you want to follow the technologies and companies that will rise in the aftermath, subscribe to receive more breakdowns like this.